Imagine if, like a single software update pushed in Silicon Valley instantly tanked the value of a hardware factory over in South Korea.
Right.
Or, if a canceled diplomatic meeting in the Middle East is the literal mathematical reason you're paying an 8% surcharge to mail a birthday present across the country today.
Which is, I mean, it sounds crazy, but it's happening.
Exactly. Welcome to the Deep Dive. Today, we are opening up a really dense, just wide-ranging global markets and technology intelligence summary. And our mission here is to trace the hidden wires connecting all these seemingly isolated events.
Because the overarching theme of these reports is really the raw speed of cause and effect in a hyper-connected world. We're looking at, sweeping structural shifts today.
Yeah.
Everything from aggressive corporate layoffs to sudden pivots in global energy strategies. And almost all of it is being driven by two engines running simultaneously, right? The relentless acceleration of artificial intelligence and a deeply unsettled landscape of global instability.
Yeah, the twin engines of chaos right now. Before we jump into those hidden wires, though, I do want to make a quick note to you listening. The sources we're analyzing today, they contain some highly sensitive geopolitical developments and major legal verdicts.
Absolutely.
So our goal here is to impartially break down the reports from this intelligence summary. We're not taking sides on the underlying international conflicts, and, we're not here to litigate the court verdicts. We're simply mapping the facts and the ideas contained in the original source material so you can clearly see the bigger picture.
And seeing that bigger picture requires us to understand the actual mechanisms at play. We really need to look under the hood to see exactly how a line of code alters physical manufacturing.
Yeah.
Or how, a tense negotiation thousands of miles away dictates the cost of your local housing.
Right. So let's start with the code, because the tech sector is undergoing a profound tectonic shift right now. Big movers like Amazon, Meta, and Google are seeing incredibly mixed results as they digest this huge slate of AI developments.
Oh, yeah. Huge shifts.
Okay, let's unpack this. Meta, for example, is currently undergoing significant layoffs. They're trimming hundreds of people across Reality Labs, their sales divisions, recruiting, and social media. And they're reallocating those resources directly into AI infrastructure.
It's a ruthless pivot. I mean, Reality Labs was supposed to be the spatial computing frontier.
The metaverse, right.
Exactly. But Meta is actively cannibalizing its existing operations to feed the AI engine. The capital intensity required to build out these large language models it's so high that even a company with Meta's balance sheet has to make zero-sum choices.
Wow.
But what is truly remarkable in the summary is how the software itself is starting to violently alter the physical demands of the hardware industry.
Yes, and that actually brings us to Google, because Alphabet just unveiled a breakthrough called TurboQuant.
Okay.
The summary describes it as KV cache compression advance that boosts large language model memory efficiency by a staggering 6 times. Now, as soon as this software breakthrough was announced, it immediately pressured the shares of hardware manufacturers like Micron, Samsung Electronics, and SK Hynix because of, sudden demand concerns.
Right, the market reacted instantly.
But I have to push back on this logic. Usually, a massive leap in tech capability means a gold rush for the folks making the picks and shovels, the hardware. Why would a massive AI breakthrough actually hurt memory stocks like Micron, Samsung, and SK Hynix?
What's fascinating here is that to understand it, we have to look at what a KV cache actually is. So think of KV cache as the AI's short-term working memory while it's generating a response.
Okay.
When you ask a chatbot a question, it stores the context of your conversation in that cache, so it doesn't just, lose the thread halfway through. Historically, that required an enormous amount of physical brute force server memory.
So it's literally taking up physical rack space in a data center somewhere.
Precisely. Now, imagine if someone invented a magical shovel that let one miner do the exact same amount of work as 6 miners.
Oh, I see.
Suddenly, the mine owner doesn't need to buy nearly as many shovels. That is exactly what TurboQuant is doing. By compressing that cache by 6 times, you aren't just saving digital space, you're fundamentally altering how many physical servers a company needs to plug into the wall.
Wow.
If an AI developer can get 6 times the performance out of their existing server racks just by updating the software layer, they are going to immediately pause their orders for new physical memory chips from companies like Samsung and SK Hynix.
That is wild. The software just became so ruthlessly efficient that it temporarily destroyed its own hardware supply chain.
Exactly. But the hardware market isn't dying overall. The capital is just migrating.
Right.
While memory stocks took a hit, ARM Holdings is moving in the exact opposite direction. They just launched a brand new AGI CPU specifically designed for AI inference.
And we should clarify inference here, because that's different from the training phase.
Right, yeah. Training is like reading the entire internet to build the brain. Inference is actually using that brain to answer your specific question in real time. ARM's new chips are hyper-specialized for that inference phase.
Huh, okay.
And because the whole industry is moving from building the models to actually running them for consumers, ARM is projecting $15 billion in chip revenue by 2031.
15 billion.
Yeah. They've already secured early customers like Meta, OpenAI, Cloudflare, and SAP, which caused their shares to jump. So capital is fleeing brute force volume and just sprinting toward hyper-specialized efficiency.
And it's not just the hardware that's volatile. The corporate partnerships are proving to be just as fragile. We learned that Walt Disney just walked away from a reported $1 billion deal with OpenAI.
Which is a massive deal to walk away from.
Right. And this happened because OpenAI shuttered its Sora video generation platform. Disney stated they learned a lot from the collaboration, but they will explore other platforms instead.
Which tells you that even the biggest entertainment conglomerate in the world is finding the generative AI landscape highly unpredictable.
Yeah.
You cannot confidently commit $1 billion when the foundational technology might be deprecated or overhauled before the ink even dries. The stabilization just isn't there yet for generative video at an enterprise scale.
Meanwhile, a company like Amazon is finding immediate, highly lucrative uses for it. They just launched their big spring sale, running through March 31st, offering daily deal drops across more than 35 categories.
Right.
And what's powering this massive retail push? They're integrating new AI shopping tools directly into the consumer friction points to optimize the supply chain and targeting.
So Amazon is flawlessly injecting AI into daily retail to reduce friction. But that frictionless integration is exactly what's getting other tech giants into deep trouble right now.
Right.
When optimization becomes too good, it crosses a dangerous line, which kind of brings us to this collision between tech development and the real world.
A massive legal precedent. Meta and Alphabet's YouTube were just found negligent and liable in a landmark Los Angeles case. The jury found them responsible for addictive design harms to a minor.
Which is huge.
They were hit with $3 million in compensatory damages, and punitive damages have been recommended. Both companies plan to appeal, obviously, but the ruling itself is a watershed moment.
It really is. It moves the conversation from the philosophy department directly into the accounting department.
Exactly.
For years, tech companies engaged in these theoretical debates about the ethics of algorithms, but this verdict introduces a tangible financial liability for the fundamental design of their products. If addictive design becomes a standardized product liability, well, the financial modeling for social media companies has to be completely rewritten.
And regulators aren't just looking at social media algorithms. They are intensely focused on the mechanics of decentralized finance, too. Coinbase is currently resisting Senate offices over compromised language regarding stablecoin yields.
Right, the crypto oversight debate.
Yeah, this reflects deep ongoing divisions as lawmakers try to negotiate market structure and oversight provisions for crypto. And you see the market reacting to that regulatory pressure in real time. Circle shares suffered a steep one-day drop amid concerns over these proposed limits on stablecoin yield before rebounding.
We have to look at the mechanics of why that matters so much. So stablecoins are pegged to the dollar, right?
Right.
The way companies like Circle make money is by taking the real dollars you give them, buying treasury bills, and keeping the yield those bills generate.
Okay. Simple enough?
But if the Senate passes legislation that strictly limits who gets to keep that yield or how those reserves are classified, it threatens their fundamental business model. That's why investors are closely watching the legislative risks, as well as competitive moves by Tether. The entire revenue engine of the stablecoin market is under a regulatory microscope.
Here's where it gets really interesting. The regulatory heat on crypto extends beyond just stablecoins. Polymarket, which is a major prediction market platform, is facing extreme scrutiny from lawmakers for potential insider trading.
Yeah, the story is wild.
And the catalyst is incredibly well-timed bets on the Iran war. According to the summary, one trader reportedly netted nearly $1 million with a 93% win rate on conflict-related wagers.
93%. I mean, it is like trying to regulate a casino where the roulette wheel is tied to live artillery fire.
Seriously.
Prediction markets are designed to crowdsource probabilities by letting people put money on outcomes. But when the outcome is a real geopolitical crisis, how do you regulate it? This raises an important question. The line between sophisticated geopolitical analysis and insider information from a state actor becomes dangerously blurred.
And from crowdsourcing intelligence on wars, we flow right into the actual physical economic ripple effects of those exact same tensions. Because while traders on Polymarket are placing million-dollar bets on geopolitical conflict, you, the listener, are about to feel the actual economic shockwaves at your local post office.
The direct translation from macro geopolitics to household microeconomics.
Exactly. The intelligence summary notes that Iran rejected direct U.S. talks, and the immediate market reaction. Crude prices climbed,
Yeah.
Brent crude went up 3.8%, and WTI went up 3.6%.
Right.
The geopolitical risk is keeping global markets entirely on edge, to the point where the CEO of Saudi Aramco canceled his appearance at the major Seer Week Energy Conference. And this matters deeply because analysis shows U.S. firms have had outsized foreign direct investment exposure across the Gulf Cooperation Council since 2020. So what does this all mean for the listener? How does a failed diplomatic talk in the Middle East actually reach your front door?
Well, because of those rising crude prices, the U.S. Postal Service is moving to impose a temporary 8% surcharge on Priority Mail, Ground Advantage, and Parcel Select.
8%.
Yeah, and this goes into effect from April 26th all the way to January 17th, 2027. The USPS is explicitly citing higher transportation and fuel costs as the reason. Because the Postal Service doesn't operate in a vacuum, right? Their transportation costs are pegged to diesel and jet fuel contracts, which trace directly back to the global price of Brent and WTI crude.
So a breakdown in international diplomacy mathematically results in you paying 8% more to ship a package.
Exactly.
But it doesn't stop at the post office. It is hitting the foundation of the American economy, the housing market. Mortgage rates have spiked to 6.43%. Because of that, purchase applications are down 5% week over week.
Yeah, real estate is feeling it.
KB Home, a major residential builder, actually cut its full-year outlook. And in their reasoning, they specifically cited added uncertainty from the Middle East conflict. How does a diplomatic breakdown actually reach a 30-year fixed mortgage?
Through the bond market. When global instability rises, like a conflict in the Middle East, investors get nervous. They start demanding higher yields, or risk premiums, to hold government debt. So Treasury bond yields spike. And because 30-year mortgage rates are directly benchmarked against those Treasury yields, the cost of borrowing money to buy a house shoots up instantly.
That is just incredible to think about.
Right. A domestic home builder in the United States is downgrading its ability to sell suburban homes because of the risk premiums being priced into global bond markets. The cost of local capital is inextricably linked to global stability.
And adapting to this volatile cost of capital is forcing physical pivots across corporate America. We are seeing companies fundamentally change where they get their energy, where they put their people, and how they build their infrastructure.
Massive, massive shifts.
Take TotalEnergies, for example. They just signed settlements with the U.S. Interior Department to completely relinquish 2 offshore wind leases. They're recovering their fees, ending their U.S. offshore wind development entirely, and redirecting that equivalent amount of money directly into U.S. LNG liquefied natural gas and oil projects.
Yeah, that's a huge U-turn.
Wait a minute, aren't we supposed to be transitioning away from fossil fuels?
Yeah.
Is this pivot purely driven by geopolitical risk aversion? Or is the underlying financial math for offshore wind fundamentally broken right now due to the high cost of borrowing we just talked about?
It is absolutely a financial math. If we connect this to the bigger picture and you look at the latest data from the Energy Information Administration, U.S. wind and solar generated a record 17% of electricity in 2025.
Okay, that's high.
And total renewables exceeded 25% of the grid in January 2026. So the grid penetration is clearly there. But the paradox is about capital allocation and interest rates.
Because building offshore wind requires billions in upfront capital.
Exactly. It requires billions upfront, locking in incredibly complex maritime supply chains years in advance. In a high interest rate environment with supply chain chaos, the math on those long-term projects breaks down.
Wow, so it's just too expensive to build right now.
Right. TotalEnergies operates on a global scale. In a world characterized by sudden supply shocks, they're finding short-term financial safety in traditional oil and liquefied natural gas. LNG is a highly liquid commodity that immediately prices into the current geopolitical premium. It generates cash flow now rather than a decade from now. It's a pivot driven by the financial anxiety of the present.
That financial anxiety is undeniably trickling down to how companies handle their labor forces, too. We're seeing a trend of ruthless optimization. Revolut, the financial app, just announced they are moving around 40% of their global workforce to India by the end of 2026.
40%?
Yeah, they're adding 1,600 roles there to reach 5,500 employees across product and financial operations at their global capability center.
And even companies that aren't offshoring are tightening their belts dramatically to survive this capital squeeze. Salesforce just announced they are freezing 2026 merit raises entirely for their director-level employees and above.
Wait, really? So no baseline standard cost of living raises at all for leadership?
None. They are opting to boost the equity and bonus pools only for their absolute top performers during their March reviews. Think about the psychological impact of that on a corporate culture.
Completely different.
It's a complete shift from baseline corporate loyalty to hyper-meritocracy. You only get rewarded if you are moving the needle significantly. It's defensive corporate behavior designed to maximize output per dollar spent.
And as we talk about maximizing output, we have to look at the physical infrastructure that supports all of this commerce, which is showing its own signs of strain. The summary details an ongoing probe into a tragic Air Canada crash at LaGuardia Airport, which involved a fatal runway collision with a file truck.
Just awful.
Yeah. Investigators found that the airport's ASDEX warning system, which is explicitly designed to prevent these exact ground collisions, simply did not trigger. Now, the NTSB is heavily reviewing the red runway status lights and examining the contributing factors.
It is a sobering reality check. I mean, we spend so much time discussing the brilliant efficiency of AI algorithms and the speed of digital finance. But all of that relies on physical infrastructure, airplanes, runways, cargo ships, power grids.
Right.
And when the automated systems in that physical infrastructure fail, the consequences are immediate and catastrophic. It grounds our entire discussion in a very harsh terrestrial reality.
It really does. It feels like the terrestrial world is just bogged down by friction right now.
Yeah.
Whether it's supply chain costs, failing runway systems, or frozen wages, which perfectly explains why the market is so eager to look up, to escape terrestrial limits entirely.
Yeah, the space race.
Exactly. The summary ends by noting that space stocks are rallying hard. Shares of Rocket Lab, AST Space Mobile, and Firefly Aerospace all jumped significantly. The catalyst is chatter that SpaceX could file for an IPO this week, which analysts say could potentially be the largest public listing ever.
It serves as the ultimate psychological release valve for investors. Down here on Earth, we are wrestling with broken offshore wind leases, mortgage rate spikes, and Middle Eastern conflicts.
Right.
But the promise of the space economy, of ascending above the geopolitical borders and physical constraints of the planet, is acting as a magnet for capital. An IPO from SpaceX isn't just a financial event. It represents a frontier that isn't currently bogged down by terrestrial conflicts.
It has been an incredible journey parsing through this single summary today. I mean, we started with Google's KV cache compression becoming so efficient that it literally paused the demand for physical memory chips.
Incredible.
We watched as a diplomatic breakdown in Iran sent shockwaves through the bond markets, leading directly to higher mortgage rates and an 8% surcharge at your local post office. We saw Meta pivoting away from spatial computing to chase AI infrastructure, while companies like Salesforce and Revolut ruthlessly optimize their workforces to survive the economic pressure.
And we saw the undeniable reality of physical infrastructure, from the tragedy of failing warning lights at LaGuardia to the financial paradox of an energy giant abandoning clean wind power for the immediate cash flow of liquefied natural gas.
But before we wrap up, there is one final forward-looking angle to all of this that we haven't touched on yet.
Right. We have talked all day about humans adjusting to these interconnected shocks, regulators stepping in, CEOs cutting budgets, builders dropping their forecasts. But here is something to mull over. As AI agents increasingly take over supply chain management and automated trading, how long until an AI model correctly predicts a geopolitical conflict on a platform like Polymarket?
Oh, wow.
Or autonomously shorts the hardware stocks and reroutes global shipping lanes entirely on its own before human diplomats even know a deal has fallen through.
When the cause and effect loop gets that tight, the machine really does drive itself. Thank you so much for joining us on this deep dive. Stay curious, keep looking for the hidden threads, and keep questioning the connections around you. Catch you next time.